Assalamu alaikum. Welcome to lecture 4 of financial reporting, and this is IAS 8. IAS 8 we use as a basis for preparation of our financial statements. Now, before starting this lecture, let me tell you that IAS 8 before the name of IAS 8 was different. Now there's a change in the name. That is IAS 8 before it was accounting policies, changes in accounting estimates and prior period error. That was the name of IAS 8. Now they have changed the name of IAS 8 to basis of preparation of financial statements, as you can see. But the content of IAS 8, what IAS 8 covers, remains the same. The only thing is name is changed and some few things are added in IAS 8. But they are general stuff. More or less whatever you have studied before under IAS 8, that is regarding your accounting policies, your estimates, your error, remains the same and they are still here as well. Okay, so in this lecture we are going to go through the terminology. Under that we are going to go through the objective, then the general matters. This general matters part section was not there under IAS 8 before. This is added now. So we are going to see what are the general matters, then fair presentation and compliance with your IFRS standard, going concern, accrual basis of accounting. Now we are going to touch each of the three elements. The three main important elements under IAS 8 are your accounting policies, your accounting estimates, and your error. And the way we deal with these three are different. Okay, so first, accounting policies. How do you select and apply accounting policies? IAS 8 tells that. Then the consistency of accounting policies. Then when you change the accounting policy, how you have to account for it. Then how do you disclose? Now moving on to the accounting estimate. When you how do you estimate? Then when you change, see, there is two things. One, how do you deal with accounting policy? How do you deal with accounting estimate? How do you deal with error? Second, when you change the accounting estimate, when you change the accounting policy, and when you correct the error, what is the impact? Two things. Next is disclosure. For all the three, error, estimate, policy, you need to know how to disclose. But remember, accounting policies and estimates are not the same thing. That's why students often get confused and they write that treatment for both the same. They are not same. The treatment is different. The things that comes under accounting estimates and policies are different. Okay. Now, error. Prior period error. Errors that have occurred before your current period. Then, when you correct the error, and disclosure. So these are the three important things for policies, estimates, error. Once, what is the impact of the accounting policy, accounting estimate, error. Then when you change the accounting estimate or change the accounting policy or correct the error, what is the impact, and finally disclosure under all the three. And then finally we are going to conclude this lecture with syllabus coverage, how much part of the syllabus we covered from this lecture, then summarize the entire lecture, and whether there are any technical articles that you have to read for this topic, that is IAS 8 on your ACCA website. Now, so by showing you graphically, you can understand that better. So basis of preparation, first we have some general matter. Under general matter, we usually prepare our account financial statements on a going concern basis, accrual basis, and we make a fair presentation and compliance with IFRS. These are the three general matters. Next, specifically we'll deal with accounting policies, where we go with the selection, then it has to be consistent, then the changes and the disclosure, and coming to estimate. Estimation, accounting treatment, and disclosure. Error, prior period error, correction, and disclosure. Now, moving on to the objective. Objective of IAS 8 is to make financial statements more useful, more enhancing. Okay. How do they make it more enhancing? It will be more relevant, more reliable, more comparable over time, and also with other entity. Because the basis, everything is in your basis of preparation. If your preparation is uniform, you can compare among the entities and also between different time periods for the same entity. That is the main objective of IAS 8. And to achieve this, they are providing guidance on general matter that are relevant for preparation of a financial statement. See, we still did not reach to the specific elements of financial statements. We'll start from the next lecture onwards, that is lecture 5. which is your IFRS 15 revenue. From lecture 5 onwards, we will be covering each element of the financial statements. We are still in the preparation. Okay, and my previous lecture, lecture 3, was on IFRS 18. IFRS 18 is on the presentation and the disclosure. Please, the link of the previous lecture 3 will be given at the end of this video. You can go and click. And if you watch that and then come back, this will be much easier for you, because many of you might be confused with IFRS 18. That is presentation and disclosure. This is preparation of financial statement. Under presentation and disclosure, we went through how do we classify assets, liability, how do we present them in which order, how do we categorize income, expense, equity, that thing. But here in IAS 8, it is about preparation. For example, we prepare based on going concern, we prepare on accounting basis, and then to prepare financial statements, you need to make some estimates. That's why we are studying accounting estimate. And if you are having any error while preparing financial statements, when you correct the error, what is the impact? And then your accounting policy. Every financial statements you prepare based on some accounting policies, which you can change. And how do you select those? So these things will be, that's why these things are taught before you actually start preparing financial statement. Because if these things are wrong, if your accounting policy goes wrong, if your estimates goes wrong, if your classification, non-current, current goes wrong, then the financial statements that you are preparing won't make any sense. No matter even if you're following the specific IFRS. For example, revenue you are recognizing based on IFRS 15. Or let's say you are recognizing non-current asset, that is property, plant and equipment, based on IAS 16. It's not going to give you any helpful, it won't give you any reliable or relevant information until and unless your presentation and your disclosure and your preparation are done on a solid foundation. And those foundation you get from this standards. That is, one is IFRS 18 that I have already taught in lecture 3. This one is IAS 8. Now you understand. Okay. So next, for selection, application and disclosure of accounting policies, then estimates, and then error. So these are the main objective. Now let us go to the general matter. So IAS 8 is giving advice on 3 matters. First matter, fair presentation. You have to be able to present fairly, and how it is achieved? Simply by complying with the IFRS standards. Next, going concern. When you're preparing a financial statements, it's a going concern and on accrual basis. First, comply with IFRS, then going concern basis, then accrual basis. Now, fair presentation. Financial statements should present fairly: financial position, financial performance, cash flow. These are the 3 things. Okay. Now, fair presentation. Fair presentation means they are going to faithfully represent. Events will be faithfully represented, and in all circumstances, it will be achieved by simply complying with IFRS. So, fair presentation also requires that entity selects and applies accounting policies. See, in order to achieve that fair presentation, to make sure that your information are faithfully represented, you also have to comply with IAS 8. Because IAS 8 tells you how to select and how to apply accounting policies. That's why. So fair presentation also means you are selecting and applying accounting policies in accordance with IAS 8. See, IAS 8, this question normally they do not ask as a number crunching question. This they ask as a theory question, as a discussion question. Okay. For example, they might ask, how can you achieve fair presentation by complying with IAS 8? Then you have to say all these points. That by complying with the accounting policies, by presenting information in so way, like this. Now, present information. Okay, when you are presenting information, including your accounting policies that you have selected, you have to present in a manner which provides relevant, reliable, comparable, understandable information. And any additional disclosure, if it is required, you are providing that also with the requirement of the IFRS standard. Okay. Sorry, when the requirement of IFRS standards are insufficient for users to understand, then you have to give additional disclosure so that users can understand. Now, statement of compliance. An entity whose financial statements comply with IFRS, they should make an explicit and unreserved statement of compliance in the notes to the financial statements. Remember this. Whenever you are preparing financial statements that complies with IFRS, you have to make an explicit and unreserved statement of compliance in the notes to financial statements. And this statement cannot be made unless all requirements of IFRS standards are adhered to. That means if you are not meeting any of the one IFRS standard, you can't make that statement. You have to meet all the requirements of the IFRS accounting standards. All the standards, not just one standard. For example, you are recognizing revenue based on IFRS 15. You are recognizing property, plant, and equipment based on IAS 16. You are recognizing intangible asset based on IAS 38, like that. Now, what happens when you depart from your IFRS standard? This also happens, but very rare. Okay, very rarely you might not comply with the requirement of an IFRS accounting standard, and if you do not do that, it's very misleading. Okay, it's going to be misleading, and it would conflict with your objective of achieving fair presentation of financial statements. If you are not complying with IFRS standard, means you cannot achieve a fair presentation of financial statements. Okay, so in this case, what should you do? This departure, okay, sometimes it is permitted by your regulatory framework. Okay, so this is commonly referred to as a true and a fair override. Sometimes you might have to depart, and when you depart, then in addition to that, because you are not complying with IFRS, you have to do something else. You have to disclose. Okay, you have to disclose the management. Okay, who has to discuss management? Management has concluded that financial statements fairly presents their entity's financial position, their performance, and cash flow. Okay, and they have to disclose that they have complied with the applicable IFRS except where they have departed from a particular requirement to achieve a fair presentation. Let's say there are 5 requirements of IFRS 50. Out of 5, you must have achieved 3 or 4. Okay, so you are saying that you have complied with all except 1 or except 2, because you are thinking that to depart from that requirement is important, because otherwise you're not going to achieve the fair presentation. See, wherever it's you feel that if you go by the IFRS standard, it is not giving a fair presentation, then do not go by IFRS standard. Then you can depart. That option is given. Okay, because the main objective is fair presentation. You have departed only to achieve fair presentation. So the title of IFRS accounting standard for which entity has departed, the nature of the departure, and the reason why the treatment would be misleading, and the treatment adopted, you have to disclose. What are the things you have to disclose? Which IFRS? Title of IFRS means, is it IAS 16? Is it IAS 38? Is it IFRS 9? Which IFRS did you depart from? That you have to write. The title of it. Then, what is the nature of departure? That means the treatment that the standard would require, and the reason why that treatment would be misleading in the circumstances, that you have to disclose. You just can't simply departure and keep quiet about it. You have to disclose why departing was important, and the treatment that you have adopted. That means treatment that the standard required, and why it is not so, why it could be misleading, and the treatment that you have adopted. You have to disclose. And after that, the financial effect of the departure on the entity's profit and loss, assets, liability, equity, cash flow for each period that you have presented. Financial effect also you have to disclose. Now, going concern. So from fair presentation, we are moving to going concern. An entity should prepare financial statements on a going concern basis unless management intends to liquidate or cease their trading. Financial statements that are prepared on a going concern will reflect an expectation that entity will continue to trade for at least 12 months after the end of the reporting period. And in making this assessment, management will consider some factors, such as they will see the history of the profitable operations, because of course if you have been profitable for many years, it's very unlikely that you are going to cease your trading. Expected profitability they will see, and debt repayment schedule. If you are not able to repay, more unlikely that you will liquidate and you will close down. Now, Format. So under going concern, we'll see the format. What has to be the format? Financial statements that are prepared on a going concern basis reflects the requirements of IFRS 18. Please check my IFRS 18 video. Link will be given at the end of this video. That is my lecture 3. They told that financial statements are prepared based on the going concern basis and other IFRS standards also. Uncertainty over going concern status. What happens when there is an uncertainty? If material uncertainties, see, I'm using the word material, not immaterial. Material uncertainties exist that can cause a doubt whether the entity will continue tomorrow or not, then entity should prepare the going concern financial statements, but they have to disclose those uncertainties. That means entity will still prepare based on going concern basis only. They will follow the same format, but then they have to disclose those uncertainties in the notes. Next, not a going concern. You have come to a conclusion, not a going concern, no doubt, not a going concern only. Then you can't prepare your financial statements based on non going concern. Then IAS 8 tells you, IAS 8 does not give the format of financial statements that should be prepared, but it does require that entity have to disclose. See, the format of financial statements, IAS 8 does not tell you. But what it has to disclose, that IAS 8 tells you. What you have to disclose? That you are not a going concern. And reason why you are not going concern. Now, accrual basis of accounting. So under accrual basis, this have to be applied in all your financial statements other than the statement of cash flow, because cash flows are based on cash basis. This means your assets, liability, equity, income, expense will be recognized when they meet the definition of these elements given in your conceptual framework. And conceptual framework was my lecture 2. I have explained all the definition of all these 5 items. Please go back and check. You can refer my lecture 2. If you click the I button that is given on the right hand side on the screen, if you click the I button, you can directly, it will take you to my FR playlist. There you can click lecture 2 and go to conceptual framework and see the definition of all these 5 elements if you want to recall. Okay. So practically, this means transactions should be recognized when they occur, not when you are receiving or paying cash. And it has to be reported in the financial statements to which they relate. Now, moving on to accounting policies. So we have finished the general matters. Now we are moving to accounting policies. How do you select and apply accounting policies? Accounting policies. First, let us understand what are accounting policies. Accounting policies are like they are your specific principles, basis or rules, like you can say, that applies by an entity in preparing and presenting financial statement. That means these are the certain ways or rules that you use to prepare your financial statements. They are known as accounting policies. When an IFRS specifically applies to a transaction, standards should be applied based on that standard. Okay. So standards should be applied to determine the appropriate accounting policy. Now, what happens? See, when there is an IFRS standard, you go by that IFRS standard and apply the accounting policy. But what if there is no IFRS standard to a transaction? Then management should use their judgment and they develop and apply that accounting policy, which will provide information that it is relevant to the economic decision making need of users. See, when you're choosing an accounting policy, make sure that it has to be relevant to the decision making needs of the user. You just can't make any accounting policy and apply for your own goodwill. No, you have to think of the users. It has to be relevant for them. Next, it has to be reliable. Okay. Next, it has to faithfully represent entity's financial position, performance, cash flow. Reflect the economic substance. Has to be neutral, prudent, and complete in all material aspects. You have to choose an accounting policy like this, taking all these qualities into picture. Now, so in developing an accounting policy, and if there is no IFRS accounting standard, management should consider, and by the way, this area, this section specifically, this slide often comes in your exam. that how can you choose an accounting policy if a specific IFRS standard is not there. This can be an area that can be tested. So make sure that you know these 3 points, and in this three order only. It has to be in this order. First, requirement of IFRS that deals with similar and related issues. If you're not having, for that specific transaction, if you're not having a specific IFRS standard, check whether are there any other IFRS standard that works with similar issue or related issue to this. Then if there is a similar IFRS standard that deals with similar issues, you can choose that IFRS standard and apply here. Otherwise, if no IFRS standard applies for similar issue, go to the second. See, if your questions for all these three is no, 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 then only you come to the last stage. But if your answer is yes, you stop there itself. If you are having a relevant IFRS that deals with similar issue, you choose that IFRS. But if you do not have, then come to point number 2. Then you have to use your conceptual framework. You have to see the definition of the elements that are assets, liabilities, income, expense, equity, recognition criteria of them, and the measurement guidance under conceptual framework. What conceptual framework has to say? Should you recognize? Should you measure them? How should you measure? Whether cost, whether fair value? Then you use conceptual framework. If conceptual framework is also not helping you, come to the third. What is third? Reasoned pronouncements of other standard setting bodies, the ones who set standards, other standard settings bodies that use a conceptual framework to develop accounting standards, but providing that this conclusion that you reach here do not conflict with your point 1 and 2. See, you will not be told to develop in your exam, you will not be told to develop a new accounting policy. No, they will ask the process only, how it is done. So only knowing this process is enough. For example, you don't have to know the detail of how it is done under standard setting bodies, how accounting policies comes, or how it is done in conceptual framework. No, knowing this much is enough. Okay. Now, example 1. This example will help you to understand how we are applying the 3.123. Here, we are not having a specific IFRS standard for this transaction. Okay. So, Kitty has purchased a Van Gogh painting to display in their client reception area. Why they want to display? Because she is hoping it will lead to more contracts and painting will appreciate in value. But there is no specific IFRS standard that deals with this type of assets. So now you will see for similar asset. First, you will see for similar IFRS standard. So one standard they have taken is IAS 40 because they told one point, that is that it will appreciate in value. Painting will appreciate in value. We don't know what type of asset painting is, but we know they told appreciate in value. So because they told this, we have a similar asset that deals with appreciation in value. What is it? IAS 40, investment property. So IAS 40 deals with a particular type of asset which is held for capital appreciation. Not painting, but yes. So in this case, you can use IAS 40 to remeasure the painting to fair value. What does IAS 40 says about measurement? That you have to remeasure at each reporting date to fair value. That's what IAS 40 says. So same thing you will apply to this painting also. IAS 40 to remeasure the painting to fair value at each reporting date. Isn't it simple? It's very simple. But provided that in this case, if there was no standard like that also, then you will go to conceptual framework and then other standard setting bodies. And they will not ask you who those standard setting bodies are, the details on all those things, procedure, they will not ask you. Just mentioning other standard setting bodies you have to refer is enough. Okay, you don't have to exactly name them or know it. Now, consistency. Just applying an accounting policy 1 year and changing it in another year is not going to helpful. You have to be consistent with your accounting policies that you have selected and applied. Okay, especially if they are similar nature, it has to be consistent because it helps to achieve comparability. You should be able to compare with different years and entity. One example is inventory, because for inventories we have to measure, and we can measure inventory using two methods, AFCO and FIFO. Now let us see this example of inventory. So IAS 2 inventory requires the inventory to be measured at lower of cost or net realizable value. So in assigning the cost, we choose the cost formula, FIFO, that is first in first out, or weighted average. Remember, the selection of the cost formula, that is FIFO or AFCO, average weighted cost is an accounting policy. Okay, so whenever in your exam you are given choices of inventory valuation, it's an accounting policy, not an accounting estimate. And mostly whatever they give you for examples or in the past papers only, they usually give in exams also. They do not give out of the syllabus. Okay, usually they give inventories or depreciation because these are your accounting policies and estimates normally which they take. Okay, so the same cost formula has to be applied to the similar items of inventory, but a different cost formula can be justified for a different type of inventory. If you're having similar type of inventory, use similar method. If it's a different type of inventory, yes, you can justify a different cost formula. Now, changes in the accounting policy. Entity can only change an accounting policy. See, it's not advisable to change accounting policy every year or very frequently. We don't do that. But you can only change if you have to change. So if it's required by an IFRS standard, that means it's a mandatory change. Not you are not changing voluntarily. Mandatory you have to change based on an IFRS standard, or you can change voluntary. Voluntary change is required, but that change would result in more reliable and more relevant information from your financial statement. That's why you're changing. Voluntary change. So mandatory change, voluntary change. Voluntary change. These restrictions are necessary because users need to be able to compare financial statements of a single entity over time in order to appreciate trends in the financial position, performance, cash flow. Why this restrictions is important for voluntary change? That it has to be reliable and relevant information, then only you can change. Because if it was not restricted, you would have changed the way you want. Then it's very difficult for an entity to compare among themselves or with other entity. That's why. Examples of voluntary change. You want to move from your IAS 40 in your investment property from cost model to fair value model. Okay, because you are feeling okay, cost model would not result in more relevant information. If you move to fair value, it will give you more relevant information. So this is change in accounting policy. Moving from FIFO to weighted average, or the other way around, weighted average to FIFO. Change in accounting policy, voluntary change in accounting policy. These are not mandatory by the standard. Changing the presentation of operating expenses and from cost of sales to general and admin expenses. When we go to operating expense, see this I've covered under IFRS 18 in my previous lecture under operating expenses, section 5. That operating expense in your income statement you can show present using two ways, nature or by function. If it's by function, it will come under what? General and admin expenses. And if it is by nature, then cost of sales. Moving IAS 16 from cost to revaluation model. Now, recognizing a change in accounting policy. New and a revised IFRS standard generally contains a transitional provision that explains how to apply a change of accounting policy as a result of applying the new guidance. In all cases, this is very important. Now, this is where you will be tested, that how you measure accounting policy. Accounting policy is applied retrospectively. Remember the word retrospectively, to enhance comparability from period to period. Retrospectively means you go back and change. Learn these two words in ISA. Retrospectively, prospectively. Retrospectively means you go back and change. Prospectively means you don't change the past, but you change the current and you change your future period. So retrospectively and prospectively. Accounting policies are done retrospectively. Retrospective application is you're applying a new accounting policy as if that policy had always been applied. That means from day one you have been applying. Practically in financial statements that includes comparatives. This means that new policies applied in your current financial statement and the comparative amounts are restated for the prior period as if new policy had always been applied. That means you have to change in two places: current financial statements and the previous financial statements of your comparative amount based on the new accounting policy. Each affected party of equity will be adjusted as at the start of the comparative period. Why start of the comparative period? Because that balance would be brought forward to your current year. So at the start of the current period to reflect the cumulative change as a result of applying the new policy instead of the old policy before the start of the prior period. This is referred to as a prior period adjustment. You go to the prior period and do the adjustment. So at the start of the comparative period, you do this adjustment when the new policy has been applied. You don't go and change before the start of the prior period. You don't go and change based on the old policy. That is the meaning of this. This will be illustrated in example 3. Now, if it is not practicable to apply the effect of changes in policy to the prior period, sometimes it's not possible that you go back and change the prior period based on your new policy. Then the change has to be made from the earliest period for which a retrospective application is practicable. A change from the cost to the revaluation under IAS 16 is a change in accounting policy. However, the accounting requirements are prescribed in IAS 16, not in IAS 8. Remember, when you change from cost to revaluation, yes, it's an accounting policy, but how you are going to deal with it, how you are going to measure cost versus fair value is described under IAS 16, not IAS 8. And this change in policy will be applied prospectively, not retrospectively. Just now I told change in accounting policy is done retrospectively. Now you might be asking me, ma'am, then why it is prospectively? See, anything dealt specifically under a specific standard, okay, cost and revaluation. So when you go to revaluate model, you change from there and the future years will be done based on that new model. That is done. That is called prospectively. Why not retrospectively? When you change from cost to fair value, you don't go back and change your prior period or your comparative period as if you have always been measured it under fair value. Cost remains whatever you have done before in the cost model. Once you start fair value, then and the later years will be the fair value model. You understand? So cost will remain cost, revaluation model will remain revaluation model. You don't go back and change the cost model to revaluation model. That is a retrospective application that you don't do. That is the meaning of this point. Okay. Now, presentation of a prior period adjustment. If there's a prior period adjustment that is done, how do you present? When a new accounting policy is applied retrospectively, IFRS 18 requires that an additional statement of financial position has to be presented at the start of the prior period. This means entity must present 3 statement of financial position. Okay, like this: 2005, 2006, 2007. So this is an example where we are going to change an accounting policy. This is based on inventory change. Okay, they want to change from weighted average to FIFO. This is about it. And they have given you the valuation based on AFCO and FIFO. And you have been told to draft. The draft financial statements has been prepared, okay, based on AFCO. You have to prepare again based on FIFO. That is the requirement of example 3. So the extracts from 31st December 2006 they have given. These are the following extracts. You see, only for 2 years they have given, 2006 and 7. For 2005 they haven't given. So this is an extract. You see, statement of profit and loss, you have been given revenue, cost, gross profit and profit. Okay. Then when you go to inventory, you take 340 for 2007 and 2006 370. Let us go back and check. That is this amount, 340 and 370, 2006 and 7. You are based on AFCO. You see, you haven't applied FIFO. So they are taking 340 and 370. In inventories, in your statement of financial position. These are just extract. Extract means just part of it. They are not preparing whole and giving you. Whole financial statements are not prepared. Then statement of changes in equity extract. You see once again here, this profit they have used here, and this they have added with your balance and got the 31st December balance. Now your requirement is redraft financial statements extracts for both years to reflect the change in accounting policy. So let us do that. So now we are going to do this. Before we redraft the extracts, we have to adjust our cost of sales, and that we can only do by adjusting the inventories based on the two valuation, AFCO and FIFO. Okay, so right now what I'm going to do, the current year, that is 2007 and 2006. Okay, you need a comparative year. So I'm going to write the inventory, the opening and the closing balance to find the effect in the cost of sales based on AFCO, that is my old method, and FIFO, that is my new method. Okay, so the latest year first. Okay, the current year is 2007 and 2007. This is AFCO. AFCO is the old, and next is FIFO. FIFO is the new one, new policy. So with old policy and new policy. Okay, same we are going to do for 2006 because we need a comparative figure. So AFCO old and FIFO new. Okay, now first item that I'm going to write is my open inventory. Okay, so my open inventory under 2007, remember your closing balance, the one which is standing at 31st December 2006 will be the opening balance for your 31st December 2007. That's how you see. So my opening balance, opening inventory for 2007 based on AFCO is 340. That is the closing. These are the closing stocks that is given. So 340 is my closing under AFCO for 2007, and 370, that is for 31st December 2006 closing balance, but opening balance for 1st Jan 2007. So 370 under AFCO is my opening balance and 340 is the closing balance. Okay, so here it is 370 opening balance and closing inventory. 340 minus 340. From opening we deduct closing to get the effect on the cost of sales. So here the net effect on your cost of sales, because your inventory will have direct impact in your cost of sales. Okay, when your policy changes for inventory valuation. So before you draft, this is the first step you have to do. You have to revalue your stocks based on old policy and new policy to get the change. So the difference, you use the sum function and get the difference. It's 30. Okay, this is the net effect on your cost of sales. Then because of the impact of your new policy from AFCO to FIFO, change to cost of sales. What would be the change to cost of sales? This you will only get once you do for FIFO also. So under FIFO, opening balance is 470 and 400 would be the sorry, 400 would be the opening and 470 would be the closing under FIFO. So 400 and 470 minus 470. Now let us do the sum function. It's a negative 70. So what would be the impact here? Let's take this, add this. The difference between these two, if you want to get in short. Sorry. So simply you are taking the difference between these two. It is this minus this. The difference is 100. But this 100 will be negative 100. Because from positive 30 to reach to negative 70, you have to deduct 100 from 30. So if you deduct 30 minus 100 would be negative 70. You understand? Now, in 2006, the opening inventory. So here, opening inventory for 2006. Now you have to compare 31st December 2005 and 31st December 2006 under FCO. So 370 and 295. 295 is the opening balance. And 370. This is under FCO. So again the sum function is minus 75. Okay, and here it is under FIFO for 31st December 2005 and 31st December 2006, 310 and 400. So 310 is the opening, 400 is the closing. And the difference. If you want to get the difference, just simply take the sum. It is minus 90. Now, see the difference between these two. Okay. It is simply the sum function. If you do, you will get it. This, comma, this. Okay. Done. So it's the difference between these two. So it's this minus this. You see? From your new, you have to deduct the old. Then you will get the right amount with the right sign. So negative 50. You have to change your cost of sales. Under old, for 2007, under old AFCO, this was the effect, net effect. But under new, the effect is minus 70. So you have to deduct another 100 to your cost of sales to reach to the new. And here you have to deduct another 15. You understand? Now, one might ask, why did we take the figure of 31st December 2005? That is, prior to 1st Jan 2006, that is 31st December 2005, okay? The cumulative difference, that means the difference in the profit is the difference between your closing inventory measurement at 31st December 2005. So that's why we have to take all our previous inventory balances that has been recognized as an expense before 1st Jan 2006. So the prior period adjustment is known as a prior period adjustment that will be brought forward to your retained earnings at 1st Jan 2006. Okay, which is 310 minus 295. Okay, so you get here. See, 31st December 2025. Only check 31st December 2005, the inventory valuation for FCO and FIFO. 50, 295 and 310. So it's a prior period adjustment. The difference between this two, 310 minus 295. So 310 minus 295. The difference is 15,000. This 15,000 will be brought forward to your retained earnings at 1st Jan 2006. Okay. Now let's draw up the statement of profit or loss extract. So this is revised. Okay. Now here also you need two years, 2007 and 2006. 2006 as restated. You have to restate the comparative figure. 2006 is the comparative figure. Now, so we start with the revenue. Look at your statement of profit and loss. Revenue, cost of sales, gross profit and profit for the year. 4 figure. So revenue, your expense or cost of sales, and your gross profit and profit for the year. So here revenue as it is you can take 10,200 and 9,100. When you come to expense, be careful. This is the place where it is changed. Look at your cost of sales. It is 6,800. So from here 6,800, okay, you have to deduct how much? Go to this table. Minus 100. You are supposed to deduct 100 for 2007. So it is 6,800 minus 6,800. Okay, it's an expense. And then you deduct this. So your expenses will go further down, not up. From 6,800, it is now 6,700 because you have deducted 100. Now here, it is 5,680. 5,680. So minus 5,680, you are going to deduct 15. So it is 5,665. Now the gross profit is simply sum function. You just have to perform the function. Do not carry forward the that. And now profit for the year. How do you get the profit for the year? Whatever you have deducted here, see here you have minus 100 here, and here you have minus 15 for 2007 and 6. Do the opposite. For profit you have to add 100 here, add 15 here with the profit already given to you. Okay, you have been given the profit figure 1760. So 1760 plus 100. That's what you do. And here the profit for the year is 1800 plus 15. That's what you do. Done. Now, statement of financial position extract. Done. You only have inventories under this to record. And closing inventories, by the way, under 5.4, not ACCA. So it is closing inventory, this 470 and 400. 400 for 2006 closing inventory and 470. So 50 closing inventory was 2007 and 2006. Done. Now balance of changes in equity, statement of changes in equity. So now we start with the balance as at 1st Jan. Prior period adjustment. Then we have restated balance. Then we have profit for the year. Okay, as given here. And then we have the balance, closing balance. 31st December 2006. Okay, so now what is the balance? See, there is one thing that you have to see when you are writing the opening balance under statement of changes in equity, that is in your retained earnings. What is the impact? If you compare 370 and 400, see, inventory valuation under ACCA is 370, but it's more under FIFO is 400. So the difference, 400 minus 370, 30,000 is your profit that has to be adjusted in your opening balance. Okay. So your balance is 23,380. With that, you will add another 30. As you can see the difference here, 30,000. 370 minus 400 is 30,000. Sorry, it's not 30,000, it's 30. You just have to add 30. Because we are not taking this figure entirely, we are dropping the zeros and taking the figure. Okay? It is 30. Because when we have dealt here, we have dropped down the 3 zeros in the extracts. Here also we have to do the same thing. We are not taking 400,000 minus 370,000, rather we are taking 400 minus 370. That's how we are taking 30 and adding here with the opening balance. Because it's a profit element, the moment of the between the two inventory valuation is the profit element that will be added with the opening balance. This is for statement of changes in equity. For 2007, we are taking that. For 2007, you will take the figure for 31st December 2006. That will be your opening balance. Okay. Now, what about 2006 figure? For 2006 figure, you can take the figure given as it is, that is 21,580. Of course, here also you will adjust, but it comes under prior period adjustment. Okay, for 2006. So that prior period adjustment was this that we have talked about. That is, look at your 31st December 2005 valuation under AFCO and FIFO. Under AFCO is 295 and FIFO is 310. The difference is 15,000. So that 15,000 is your prior period adjustment that you will add here now. 15 you will add. Okay. So your restated balance would be the sum function of this two. It is this and profit for the year. And here also sum function. Your profit for the year is your profit that you have got here. One is 60 and one is 15. So 1860, 1815, and use the sum function and get the balance. So from restated balance, add the profit and do the same thing here. Okay, so that's it. You have extracted your statement of profit and loss, statement of financial position, and statement of changes in equity. Okay, let me tell you where the change took place. The change took place here and in your profit. Why? Here in 2007 figure you have deducted 100 and that 100 you have added in the profit, and here this 50 you have deducted here and you have added here. And inventory you wrote 470 400, that is your this closing inventory under FIFO, and then 400 is your opening inventory under once again FIFO. Okay, because opening will be the closing for 2006. So you write closing inventories in statement of financial position, only one line item, because the change in accounting policies in inventory. So there's only we write inventory. Next, when you come to statement of changes, this opening balance 23,380. Remember, you have to adjust it. There has been a change in the valuation of inventory. Difference is 30,000. That 30,000 is a profit element that has to be added here. We have added it. But when you come to 2006, this is a prior period adjustment of 15. Again, the difference is between the valuation 295 and 310. And then we get the restated balance and we take this profit figure and add here and get our closing balance at 31st December 2006. So that's it for this question. So this is the solution which we have done. This is what exactly we have done. We have got the 2007 figure and 2006 because we need a comparative. We need the closing balance of 2006 becomes the opening balance for 2007. So you need this. So we have AFCO on one side, that is under old method, and FIFO, the new method. And this we have got based on the valuation that is given to us. Opening inventory and closing inventory. Remember, the closing inventory of 1 year becomes the opening inventory of another year. Okay, and then you get the net effect. So the difference, you keep both the difference and then you compare the difference between old and new. So it's 115 that you have to adjust. Then based on this, we have redrafted our statement of profit and loss where the difference is 115. Under expenses we deduct, under profit we have added it, and closing inventory for 2007 and 6 we have written under the statement of financial position as 470 400. And then in your statement of changes in equity we have taken the new profit figure, and there's a prior period adjustment of 15 in 2006, and in 2007 the difference of 30. Based on the different valuation we have added it and got the closing balance. Now moving on to the disclosure part of accounting policies. First, when you disclose, it is your selection and application of accounting policy. An entity should disclose material accounting policy information. Accounting policy information is material if it can expect to influence the decision of the primary user of financial statements. That means someone is making decisions only based on those financial statements. Okay. Next, entities should also disclose judgment that they have made in the process of applying accounting policies. Now, accounting policy information is material if it relates to a material transaction and entity has changed its accounting policy during the year. An accounting policy choice is permitted by an IFRS. For example, under investment property, allows the cost value or fair value model. So in these places, your accounting policy information is material. First, if a specific IFRS standard is giving a choice in accounting policy, that is material, you have to disclose. One example is investment property. Another one is IAS 16. Next, if an entity has changed its accounting policy, it's material, you have to disclose. If there is no specific IFRS standard that applies to the transaction, again you are using a judgment to use develop accounting policies, you have to disclose. It's material. When you have applied, significant judgments or assumptions are used to apply the accounting policy. Then, accounting is complex and users of financial statements would not otherwise understand the transaction if you do not disclose it. Then you have to disclose. Then it is considered that the transaction is material. So remember these 5 areas. Any of these 5 could be tested in your exam. Okay? Entity could change, entity is changing policy, there is no specific IFRS standard, or there is a choice under an accounting policy, significant judgment has been made, or accounting is complex. Now, when you change the accounting policy, so when a new IFRS standard is applied for the first time, you have to disclose these things. The title of your new IFRS and the nature of change in the policy, when this standard is applicable, that the change is made in accordance with the standard's transitional provision. You did not change the accounting policy, but you changed based on the transitional provision of the standard. And also the description of those provisions and the effect that the provisions might have on your future period. You have to disclose. This is when you're changing the accounting policy. These things you have to disclose. Then, when it's a voluntary change, you have to disclose the nature of change in policy, reasons why new policy is giving more reliable and relevant information, and for any change, this has to be there for current period and the each prior period that is presented. The amount of the adjustment for each line item that is affected in a financial statement. This we have just done now for stocks, inventory. Then amount of the adjustment relating to periods before those presented. If a retrospective restatement is not practicable, that means you can't go back and restate, then the circumstances that led to the existence of the condition and the description of how and from when the change has been applied. Then you have to describe how you have applied the change and from when. Now, sources of estimation uncertainty. This also you have to disclose because you have to use some estimation for accounting policies. Okay, so an entity has to disclose about the assumptions that they make about the future and other major sources of estimation uncertainty at the reporting date if it has a significant risk of resulting in material adjustments to your carrying amount of assets and liabilities within the next financial year. That means if in the next financial year your carrying amount of assets and liabilities could significantly change, or if a material adjustment is needed, risk is significant, you have to disclose this. Now, from accounting policies, let's move on to accounting estimates. So estimates mean monetary amounts in your financial statements that are subject to measurement uncertainty. You have estimated, it's difficult to measure. Many accounting policies require that items are measured with an element of estimation attached. So in this case, an accounting estimate is required in order to apply the policy. In order to apply the policy also, you have to make some estimate, okay? These are the examples of accounting estimates. Remember this now. In your exam, see to it what is given. If IAS 8 is tested, is it prior period error? Is it accounting estimate? Is it accounting policy? Then accordingly you will deal. If it's a loss allowance for the expected credit loss on receivable, it's an accounting estimate. You have to estimate how much will be the loss. This is your IFRS 9. Net realizable value of inventory. Again estimate, IAS 2. Fair value of asset or liability. Estimate. Depreciation expense for property, plant and equipment. Estimate. Provision for warranties. Estimate. So if any of these 5 areas are tested, they are estimates, not accounting policies. But if there's a change in valuation of the stocks, that is accounting policy. Now, when you change the accounting estimate, okay, then this happens. Changes in the circumstances on which accounting estimate was based. Okay. Maybe, see, why does that accounting estimate changes? Maybe the circumstances has changed on which you have based your accounting estimate. Or some new information came. Or now you have more experience, so you are changing an estimate. A change in accounting estimate is recognized prospectively in the current and the future, not going back and changing, restating, unlike accounting policy. So that's why estimates are a little easier than policy. because you don't have to go back and restate. You don't need comparative figure. You just have to change current and the future prospectively. That's why I've highlighted the word prospectively. So remember these words: accounting policy retrospectively, accounting estimate prospectively. A change in an estimate is not an error, please understand. Just because you're changing an estimate does not mean an error has taken place. No, it's a change in accounting policy. Therefore, it will not affect your previous year's financial statement. Okay, an error and an accounting policy you have to go back and change because it can affect your previous year's financial statements but not accounting estimate. If the change in accounting estimate affects the measurement of assets or liability, then that change will be recognized by adjusting the carrying amount of your asset or liability. For example, let's say there is a change in the estimated useful life of the depreciation asset. What happens? Then the carrying amount at the date of the change is depreciated over the revised useful life. You don't take the old useful life, revised useful life. You will keep on depreciating at the date of change, whatever is the carrying amount. Okay. Now, disclosure for accounting estimate. If there is a change in accounting estimate, entity has to disclose the nature and the amount of the change in the estimate, which has an effect in the current or in the future. If it is not possible to estimate the effect on the future, at least disclose the fact. Now, finally, errors. So we have moved the final part of this lecture, that is errors. Prior period error. Error that has been identified. Okay. It can be identified anytime. It can be made in the current year, previous year, or subsequent year. An error that is identified in the year that it was made is corrected easily by adjusting the accounting record in the current year. Simple. So IAS 8 says, IAS 8 guidance specifically applies to errors identified in subsequent years, often referred to as prior period errors, not in the current year, because current year is very easy. Go and change the accounting records of the current year. But if it's a prior period error, remember that error can have an impact on various financial statements. So IAS 8 is guiding you towards that prior period error. Okay. What is prior period error? Omission or misstatement in the financial statements for one or more error. Okay, for one or more prior period arising from a failure to use or misuse reliable information. Maybe you have failed to use the information, or you have misused the information that was available when the financial statements for those periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in your preparation and presentation of financial statements, but you did not take. Such errors can include the effect of a mathematical mistake, mistakes in applying your accounting policy, or misinterpretation of facts, and could be fraud also. Now, correction of error. An error is corrected retrospectively. This treatment is similar to what? Accounting policy. When you change your accounting policy and when you correct your error, same treatment. So the difference is only in your accounting estimate that is done prospectively. Error. If an error was made in the comparative prior period, three things you have to do. First, your financial statement of the current year are presented as if the error had never been happened. It never was being made. And your comparative amount presented in your current year financial statements are restated as if the error had never been made. So two things, current year, comparative amount, both are restated. Sorry, those are the two things. Now, if an error was made, see this is when an error was made in the comparative period. These are the two things. What if the error was made before the start of the comparative period? Then what do you have to do? Then you have to do these things. Number one, financial statement of the current period are presented as if the error had never been made. That is same. Comparative amount also presented in the current year, restated as if the error had never been made. Again, same like before. And one more thing is added. The opening equity balance of your comparative period will be adjusted to correct any error relating to the earlier period. This third point, please recall the examples that we have just done based on inventory under FCO and FIFO. Same thing we have done where we have added the 30 with the opening balance of statement of changes in equity for 2007. But in 2006, we showed it as a prior period adjustment, that 15. That 30 was this. Okay. Now, in this case, IFRS 18 is requiring an entity to present an additional statement of financial position at the start of the comparative period. We already had those three. That's why we had 31st December 2005 also. That is the start of the comparative period. So 3, 2005, 2006, 2007. Now, if it is not practicable to determine the period specific effect of an error or on comparative information for prior period presented, then restate the opening balance for the earliest period for which retrospective restatement is practicable. Okay. Now example 4. So let us go through example 4. It's an example of a prior period error accounting treatment. So in this year, it was discovered that Green had recorded 12,000 as selling expense that actually related to personal travel cost. He had fraudulently reimbursed himself with that amount from the business bank account. Of this amount, 2,000 relates to 2006, 3,000 relates to 2005, and 4,000 relates to 2004. So 2 plus 3 is 5, 5 plus 4 is 9. What about the other balance 3,000 out of 12? The other 3,000 relates to 2003. How many years? 2006, 2005, 2004, 2003. So from 2003 to 6 they are showing you. Financial account has agreed to repay the full balance. The financial accountant. Now, this is how the error is corrected in 2006. Okay. So when you go to 2006, look at what you will do in 2005. So you increase the opening retained balance at 1st Jan 2005 in the statement of changes in equity by this much relating to 2003 and 2004. Earliest years 2003, no? And then 2004 also. Both will affect on your 1st Jan 2005. So 2003 has 3,000, 2004 has 4,000. So 4 plus 3 is 7,000. So increase your retained earnings by 7,000 at 1st Jan 2005. Okay. Why 1st Jan 2005? It's a comparative period for 2006. You need from 1st Jan to, see, your year end is 31st December 2006, but you need not 31st December 2005, but from 1st Jan 2005. You have to go 2 years back. Always go 2 years back from 31st December 2006. That's how you get the opening of a prior period. That is 1st Jan 2005. Always do this. Always minus 2 years. So from 31st December 2006, if you go 2 years back, starting is 1st Jan 2005. That's why you have to restate this amount by increasing the opening retained balance by the figure relating to 2003 and 4 in your statement of changes in equity. Point number 1. Point number 2. Decrease your selling expense. So you have recorded it as a selling expense, but they are not your selling expense. So that means you have to decrease. You have already recorded them as a selling expense, means your selling expense went up. Now you have to decrease it. Please understand. That's why decrease your selling expense. If your selling expense decreases, means your profit will increase. In 2005 comparative statement of profit and loss. And how much? In 2005, okay, see, you need the figure. Okay, how much is in 2005? 3,000 relates to 2005. This 3,000 relates to 2005. So in 2005 comparative statement of profit and loss by 3,000, and you will record a receivable. How much is the receivable? From 2003 onwards, that is 3,000 plus 4,000 plus this 3,000 of 2005. So total 10,000. Okay, total 10,000 you will record as receivable. Now, decrease selling expense and so increasing profit in 2006 statement of profit and loss. This is comparative statement, but this is now 2006 also you have to do the same. Decrease selling expense, increase profit in 2006 statement of profit and loss. See the word here, you have to write the word comparative. Here just statement of profit and loss by 2000 because 2000 only relates to 2006, and increase the receivable by the same amount, that is to 12,000, because in 2006 your receivable has to be 12,000. Okay, remember this 2000 relating to the 2006 is not taken here, that's why receivable is 10,000 in 2005. That is comparative statement. Okay, now the journal entry to correct. First one is for 2005 comparative financial statements, 2006. So here you debit receivable 10,000, credit selling expenses 3,000 for 2005, and retain earnings will be credited because profit increases by 7,000. If you see, it should always balance, your debit side should always balance your credit side, otherwise your journal entry is incorrect. So your credit is 10,000, debit is also 10,000. Coming to 2006, receivable is 2,000, selling expense credit 2,000. Here also is balancing. Next, example 5. Here, this is extract given for 2004-5 revenue, gross profit, and in share of statement of financial position you have been given share capital and retained earnings. So during 2005, finance director discovered an error in the inventory count at 31st December 2004, meaning closing inventory balance in the 2004 financial statement was overstated by 0.9 million. Now you have to explain how the error is corrected and redraft the extracts of the financial statement. So let us do that. First, how the error will be corrected before we redraft the financial statement. So this is the solution. So the current year cost of sales is overstated. Okay. Since inventory was overstated, current year cost of sales is overstated by 0.9 million. Okay. Why? Because inventory at 31st December 2004 is the opening inventory in 2005, and it will increase your cost of sales. So anything overstated, opening inventory, if it is overstated, means cost of sales is higher. So the corrected cost of sales is, and the corrected gross profit is, we'll see how. So cost of sales you have to deduct now. If it's overstated means you have to deduct. And your gross profit will be, what you have to do with your gross profit? Add. If you are deducting from your cost of sales, your gross profit will be higher by the same amount, 0.9. So let us move on to cost of sales. Your cost of sales is 11,600. It is overstated. So 11,600 you will deduct. From 11,600 you will deduct 900. So 10,700 or 10.7 million. That is your corrected cost of sales. And gross profit, if you see, is 12,700. So 12,700 you will add 0.9, 13,600. Now coming to point 2, the prior year cost of sales is understated by 0.9 million. Current year is overstated, but the prior year is understated. Why? Because the inventory at 31st December 2004 is the closing inventory in 2004. And if closing inventory is overstated means it will decrease your cost of sales. So now do the opposite. Now add 900 to your cost of sales and deduct 900 from your gross profit in the prior period. And the journal entry is given like this for 2005 when you're correcting. You debit retained earnings because profit will go down, and credit cost of sales because cost of sales you are adding 900,000. Okay. So this is only given for illustration purpose, this part. This part was not asked, but for illustration purpose, the debit entry is reported in your comparative statement of profit and loss for 2004 as shown below. So the adjustments to your cost of sales will impact your retained earnings. Okay, let us go back and check the figure. That is 43,200 and 39,300. It's already given here. The retained earnings, already take the retained earnings. So 43,200 and 39,300. And so with that 43,200 and 39,300, do the adjustment. So the profit, the current year, okay, that is the first one. In the first one, your profit, you have to deduct. Sorry, adjustments to 2004. The prior period, you have to deduct 900. So that's why we have deducted 900 from both the years. When you come to the adjustments to 2005 profit, only 2005 profit. So you add that 900, that is the current year. You understand? So now you get your corrected balance. For 2005, it is 43,200 only because no impact. You are deducting 900, you are adding 900. But in the previous year, it is going down by 900. Okay. Now, we'll do the statement of profit and loss versus statement of financial position. So what are we doing here? Revenue as it is we are taking, cost of sales we are taking the new figure and getting the new gross profit. So cost of sales was given as 11,600 and we deduct 900 and we are getting 10,700, and here we are getting 10,400 and we are adding the 900 and getting 11,300, and our gross profit changes. And then share capital remains the same and retained earnings only for 2004. This figure will change. It will go down by 900. That is the only difference. Now let us read the notes to this. So the correction of the error in 2004 is simply moving an expense from 2005 to 2004. Therefore, there is no effect on your retained earnings balance at 31st December 2005. There is no prior period adjustments to retained earnings brought forward at the start of 2004 because errors did not relate to the periods earlier than 2004. Note, if the question had not required a preparation of cumulative statement of profit and loss for 2004, then a prior year adjustments to retained earnings at 1st Jan 2005 would be disclosed in your 2005 statement of changes in equity. Okay. Now, disclosure. Where a prior period error is corrected, this has to be disclosed. Nature of the error, for each period presented, the amount of the correction for each line item affected in financial statement, amount at the correction at the beginning of the earliest period presented, if retrospective restatement is not practicable, circumstances that led to the existence of condition, and description of how and from when the error has been corrected. So that's it. We have finished IAS 8 very beautifully. Now we have touched on section A, small part of this. I know we have finished the major part of section A. You might be asking, ma'am, why again section A? We have just finished reading consumption framework lecture, that is lecture 2. But a little portion of it is remaining, which we have covered here. That is under need for conceptual framework and useful information. We have discussed whether faithful representation constitutes more than compliance with IFRS standard. That means just complying with IFRS standard, is it giving a faithful representation? So faithful representation is one of the useful characteristics of information. That's why it is in section A. Then we have discussed the principles of comparability in accounting for changes in accounting policy. Then under section B, accounting for transactions, we have reported financial and non-financial performance. That is We have account for changes in accounting estimates, accounting policies, and a correction of error. Now, let us summarize the lecture. So, the fair presentation of your financial statement is presumed when an entity complies with the IFRS standard. That means, if an entity complies with IFRS standard, it is a presumption that your financial statements are fairly presented. No doubt. In extremely rare circumstances, one might depart from IFRS standard. They might not go by the requirement of IFRS standard. Why they are departing? To achieve fair presentation. But if you are departing from an IFRS standard requirement just to achieve fair presentation, you have to disclose it. Financial statements are prepared on a going concern basis unless there is an intention to liquidate or you are ceasing trading. Accrual basis of accounting is applied in your financial statements preparation, except statement of cash flow. Then, when there is no IFRS standard to an accounting policy, you have to develop one that provides relevant and reliable information. Accounting policy can be changed voluntarily, but if you are doing so, it should be applied retrospectively. Accounting estimate is a monetary amount in your financial statements that is subject to measurement uncertainty. A change in accounting estimate is applied prospectively. Error is corrected retrospectively. Then, retrospective application of a new accounting policy or retrospective correction of an error involves one thing. One is common. That is, you have to restate your comparatives for both, as if the new policy have always been in place or the error had never been made, and you are presenting your prior period adjustments if the new policy or correction affects the period before your comparative period. This you have to remember, it's a must. Because remember, in your exam you will be given at least one question where it could be a change in accounting policy, or it could be change in accounting estimate, or it could be a correction of an error. Any one of these three could come. That's why knowing the right treatment and when to change the comparatives, restate the comparatives is very important. Now, there is no technical articles on this lecture, that is IAS 8. Thank you for watching, and I shall see you in the next lecture. The next lecture is a very exciting lecture and very important also, because it is going to talk about IFRS 15. So from next lecture onwards, we are moving on to the elements of financial statements, how each element of financial statements are dealt under various standards, starting with revenue, the first item in your statement of profit and loss account. That is IFRS 15 that we are going to do in lecture 5. Make sure that you watch my previous lectures. That is my lecture 1 IFRS, lecture 2 conceptual framework, and lecture 3 IFRS 18, and also this lecture. The link of this lectures is given at the end of the lecture, or you can simply click the I button given on the above screen on your right hand side, and you can get to my FR playlist and watch all my lectures. And also, if you want to access the PDF slide of this lectures, you can contact me on my email at accsabyak@gmail.com, where I will give you the details of the payment for making the payment for the slides. Thank you once again.